Good morning and welcome to the Killik & Co podcast, 19th of May. Last week we saw some interesting moves both in equities and in the bond markets. The bond markets saw some quite sharp rises and commensurate yield falls. We'll show some charts later. At the same time, equities came off. The S&P 500 that's been flirting with 1900 came back to around 1875. So maybe a switch out of equities back into bonds, having felt the market feeling a touch tired of late, was the sort of view around the floor. We'll take a sort of closer look at that on a few of the charts, but also looking ahead to this week. The economic data, we'll have some interesting sort of minutes out from the Fed, and we also have in the UK here data points around retail sales. So again, really just some sort of key markers in judging the economic growth in the UK at the moment. I have heard some people questioning whether or not the move in bonds last week was an indication that we may have seen a peak in economic growth here in the UK. So really just at a bit of a T-junction for financial markets, and so a lot of these things need monitoring quite closely for predictions of where we head from here. Just starting off with a quick look at the UK diary for the week ahead. Again, those in dark mean that we have we'll have a view. Not much out for us this week, but Vodafone numbers out tomorrow. At the weekend, also a lot of talk around AstraZeneca and Pfizer. The other deal that took place was AT&T taking over DirectTV for an equivalent sum of around $70 billion. The thinking is that AT&T were a possible suitor for Vodafone to take them over now that the Verizon stake was out of the way. So of course them choosing another target has caused Vodafone share price to be weak of late. We also have a trading update from Marks and Spencer tomorrow, and as per normal, the press were covering that in full at the weekend. They expected that they're still struggling to produce a credible result in the fashion sector in ladies wear. So let's take a look at some of these charts. So as I say, the key really last week was what is happening to yields, not just in the US but in the UK and also in Europe. This chart shows the yield that you would receive by buying the bonds, 10-year bonds of the US government, the US Treasuries. And this was the chart that we were observing just 2 or 3 weeks ago when we reported on that survey that Bloomberg had undertaken with 67 economists. All 67 had indicated that over the next 6 months they expect the yields to rise. Well, it's promptly fallen, and that sort of 2014 low that we're seeing of around 248 on the yield is indicative or interesting as to what that message is sending at the moment. I have read that there is obviously a bit of a switch out of equities into bonds at the moment, and as a result that is driving up the price of bonds and driving yields lower. But the slightly darker argument is one where are these bond yields indicative of something slightly more nasty around the corner, particularly with regards to economic growth. Certainly the Q1 number from the US was very disappointing. It's being put down as weather related, but indications will need turning, certainly for Q2. That's not a number we'll see quite yet, another couple of months away before we see that. But that number, that chart had a similar pattern here in Europe. So for Germany, you can see that is down to 1.322 on the yield. Just for reference, at the worst point in the crisis, the German yield was down at 1.1. It wasn't there for long. That was a sort of sharp spike down at the sort of peak of the turmoil. But it's a really sort of very much a concerted move from 2%. This was yielding back in September of last year and back to 1.3. We have really seen sort of growing conviction that the ECB on June 5th are going to be taking more action. Will it be full out QE? Well, the view is not, but they are looking at rate cuts across the board and help for smaller businesses. That seems to be the consensus thinking at the moment. But an interesting article in the FT this morning from Mohamed Al Erian from PIMCO, indicative that QE will come at some point this year. So interesting sort of conversations around ECB action. It's the same with France, again down to 1.79%, and similar here in the UK at 2.55. That premium really indicative of what is perceived to be a faster growing economy at the moment, and a move higher in interest rates earlier than expected. We have observed that we think the market has got itself a little bit ahead of itself in terms of its sort of pathway for interest rate rises here in the UK, which we covered in our daily note at some point last week. Turning to some of the stocks to focus on, well, AstraZeneca is dominating talk this morning as they have rejected the £55 final offer from Pfizer, and so Pfizer, the takeover period extends to the 26th of May to lodge a formal offer, but they will only do so if they have the recommendation of the board. As they don't have that, really the market has sold the shares of AstraZeneca down to around £41 at the low this morning, £42.86 at the time of speaking, so trading way below the indicative offer that was presented. So the market takes the view that this deal is off, but the work that Pfizer will undoubtedly be doing with its advisors will be whether or not they can convince the shareholders of the merits of £55, and whether or not those shareholders would be vocal enough to suggest to the board that they need to overturn their recommendation. If not, it will possibly be for Pfizer to walk away for 6 months and maybe renew interest at that period of time. Vodafone, mentioned earlier, just to say that's on the back of the AT&T deal that we've seen a little bit of relative weakness, but results, as I say, due tomorrow. Just picking on Richemont at the moment, we do have some sort of guidance following their results last week. Broadly, the share price was anticipating some poor news. In fairness, the results came in line with guidance, but there is signs that the luxury goods end of the market, there is signals of slowing growth, and particularly in the watch market. So we're turning more neutral on Richemont at the moment. And finally, we did have an encouraging meeting with Standard Chartered, one of the big underperformers in the banking sector for last year. Really sort of two things have been driving the stock lower in terms of their performance, one of which relates to their derivative business, which has gone and will not be coming back. So there are sort of parts of the business which have now sort of turned for good, but there are other restructurings within Standard & Chartered which should start to yield better returns. So a much more upbeat sort of comment from Standard & Chartered, and which in the near term we think could give it some relative strength. That's all from us. Look forward to speaking next week.